I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's guest is one of the best qualified people in the London market. In a 30-year career, he has been a senior executive right at the top of Lloyd's and has either chaired or sat on the board of almost all the institutions that underpin the market and represent it to the outside world. Today, Sean McGovern is the CEO of UK Lloyd at AXA XL and has just taken over the chairmanship of the Lloyd's Market Association, the LMA, the trade body that represents corporate capital in Lloyd's. Sean will speak for both organisations at varying times in our chat today. The timing couldn't be better. In recent years, the LMA has really set the agenda on some of the most strategic developments in the way that underwriting takes place in the subscription market. And this discussion goes right to the heart of how a future Lloyd's will underwrite, how business will be brokered, and how capital and new talent will access the market. I've been interviewing Sean for 20 years, and he has a great skill in communicating in a really eloquent, but also very direct and concise way. He's very good at speaking plainly and making complicated ideas easy to understand. Today's podcast is no different, and this is one of the most broad-reaching and enlightened conversations I've had with anyone since founding the podcast over 6 years ago. As Lloyd's embarks on a fresh 5-year strategic plan, this is a great primer on what all the issues are, where the opportunities lie, and what strategic decisions have to be taken for the market to continue to prosper. So listen on and let Sean bring you up to speed. Enjoy the podcast. Sean, welcome back to the Voice of Insurance.
Great to be back, Mark.
Today, you're not wearing a hat, but if you were wearing, we're talking about metaphorical hats. You're wearing the metaphorical hat of the chairmanship of the LMA.
Indeed.
Which is the body that represents the capital that backs the syndicates at Lloyd's, or the corporate syndicates at Lloyd's. What's your agenda?
Well, we were just chatting about the fact that I've been in the market now for 30 years.
You've been chair of most of the bodies that you could be chair of, I think.
It's a privilege to be able to be chair of the LMA. It really is. And my agenda it's not my agenda, it's the LMA's agenda, it's the LMA board's agenda. And it's around 5 things. So the first thing is the LMA does sterling and vital work when it comes to technical expertise in the market, enhancing that technical expertise, growing it, nurturing it. It's core to what the Lloyd's market is able to deliver for brokers and for clients, and that extends from underwriting through to wording. So that's a core deliverable. It really benefits the market as a whole, but also the members of the LMA. Huge amounts of technical training. Literally hundreds of managing agents' employees go through the LMA training program every year. So that is, again, a core offering the LMA makes to enhance skill in the market. The third area is around the advocacy. So you mentioned the role of the LMA in representing the interests of managing agents.
I suppose that's where, as a journalist, that's the bit that I would interact with, I suppose, because that's the bit where it's the public side of it.
Yeah,
obviously.
That's certainly the more high-profile element of
as a journalist, I'm not going to do a report about your training.
No. But I think it's important to start with the core fundamental missions that touch every managing agent, pretty much every day in terms of the expertise the LMA is able to bring to the market. So yeah, you're right. The advocacy is probably the more visible face of what the LMA does. And that advocacy is across Lloyd's, it's across the FCA, it's across the PRA, as well as the government, as well as, major markets in which Lloyd's trades. And that's really just making sure that managing agents' voices are heard on issues that are of concern to us. As policy is developed, whether it's by Lloyd's, by the 2 regulators in the UK or further afield, and that policy is developed by the board. So we will take positions on things, and then the LMA's role is to advocate to those audience for what it is that we as managing agents in the market are trying to achieve.
What are you mostly advocating on at the moment? Obviously, the market is changing. I would expect Lloyd's, and certainly we've heard Lloyd's making more, not negative noises, or to say that we're going to really make sure that everybody's business plan's absolutely in order. We're going to really keep a special eye on MGAs and other things, for example, that they've been talking about, delegated underwriting, all sorts of things. And I suppose as the market turns, one would expect that scrutiny level to be slightly dialed up.
Yeah, so if we sort of break it down into some chunks, if you like. So if you look at it from a regulatory policy point of view, a key priority, particularly for this year, is to look at how we can simplify the UK regulatory regime. There is a tailwind behind that, given the growth and competitiveness objectives that the UK regulators have been set by the UK government, which is good. But there's some follow through and progress we need to continue to see across both the agenda of the PRA, but also the FCA. So if you take the FCA, for example, looking at the modernisation, if you like, of the consumer protection requirements of the FCA, where you will know we have struggled sometimes to have the distinction made between a wholesale market and a true consumer market. Clearly, we've started to see some progress from the FCA, but we need to see continued momentum behind that because those things drive cost. We have seen businesses in the market exit from certain lines of business just because the regulatory burden is too high. And we've seen a bit of a disconnect between what the UK regulators are looking to achieve and what overseas market regulators are looking to achieve. So that, to me, is a big priority, is looking at how do we continue to drive that simplification into the FCA regime. And that's a shared mission that we have with the IUA, with LIBA for the brokers. This is an area where we can, through the LMG, we can act in real concert to try to bring...
So the LMG, for anyone listening, that's the kind of super group.
The super group, yes, yes.
So Lloyd's, LIBA, the LMA and the IUA said. So that's basically all the stakeholders in the London market.
Where we basically try to, as much as we possibly can, take a common position, because if we can speak with one voice as the London market, that is very powerful to audiences we need to get to.
Yeah. So do you think we're actually going to get some progress? Is it about you just arguing about semantics of how do you define what a wholesale customer is as opposed to, a retail customer?
There's inevitably a little bit of detailed work that has to be done. And
it is difficult, though, isn't it?
The definition of a consumer and getting that right. And it sounds small, but it's actually implications are quite big.
Wouldn't it? Because forever, on the investment side of things, for example, there's always had that sort of definition of what is a sophisticated investor. So couldn't we have something about what is a sophisticated insurance buyer? I mean, that might work. Was that the sort of approach we're going to take?
So the path we're trying to encourage the FCA to go down is precisely that, which is let's be very clear what a consumer is with an eye to what protections does that particular consumer need. We are seeing some progress. We're getting good engagement from the FCA on that, but we need to keep pushing.
Well, good. I'm looking forward to progress on that because, yes, they don't really need a lot of protection. These people very much look after themselves. I'm sure if they ever felt that you hadn't treated them fairly, they would sue you. So,
well, and of course, the market is intermediated. So there are brokers there representing the interests of pretty much every client that does business in the Lloyd's market. So that is an added protection in that they've got a client advocate who's the broker whose job it is to protect the interests of the consumer.
So we're looking forward to that. And obviously, so I just had to do a podcast with the Lady Mayor as well. Again, one of your
colleagues, yes.
At Lloyd's, sitting up on the 12th floor. It seems like all the styles are coming into alignment. So it'll be in a meeting with the LMG at one moment, and then Sue will have them round for dinner as to remind them, you've got plenty of levers at your disposal this year.
Yeah, I think the government is certainly now very much alive to the London market. Lloyd's market is a real asset for financial services in the UK. The Chancellor hosted a meeting of insurance leaders last year at number 11. These things can feel symbolic, but actually they're quite important because it creates a sort of level of interest and momentum behind you actually need to help us nourish this market so it can continue.
20 years ago, you didn't have dinners like that, did you?
No. So I think there's some things we can really feel positive about, but that's come about great work from Caroline Wagstaff, who's the CEO at the LMG, and associations across the London market working very closely together to drive the agenda.
Anything else on your LMA agenda before we move on?
Yeah, so if you then step away from, so we've talked about the sort of technical work, we've talked about the lobbying work. If you then look at the work that we've been doing on the digital agenda, so what is the future trading setup for the market to be successful in the future? The work that Sheila's been chairing the Data Council, that's been great at helping to get common understanding across the market as to what are the basic things we need to agree on to facilitate digital trading. And then outside of that, the work that, again, the LMA has led on trying to provoke the debate within the market about what the future structure of the market is going to look like. We know the subscription market is changing. We had the report last year on enhanced underwriting, which looked at how it was that the development of different follow structures would work. And then only last week, we launched the second report, which was really the role of the leader. So I think there's a real role for thought leadership from the LMA on holding the mirror up to the market and getting a debate going, which is ultimately all intended to make the market stronger for it. And that is not defining what we think as the LMA, the structure of the market is we're seeing some trends. Let's all be intelligent about what those trends might mean, and let's equip ourselves to understand as a market and as individual businesses how we're going to respond to that change. So there's an important element of thought leadership of driving the digital agenda within the market. And the fifth and final piece of the agenda is around culture and talent. So it's around how do we ensure that the market has what it needs to both reflect the society we serve, but also drawing talent from every area of the world that we can. So being very sensitive to how do we make the market more accessible to the widest possible pool of talent. And also, how do we make sure that we are being intelligent about bringing the right talent into the market to ensure the market's longer term future?
It's really interesting at the moment. There seems to be almost a paradox that in the same morning, I can read a story about how loads of people are going to retire, or the average age of the market's going up all the time, and we're going to run out of talent. But other stories of high youth unemployment and also just seems to be a bit of a downturn in graduate hiring, maybe, and people speculate whether it's because of AI or something. People are worrying, in sectors like ours, that our firms sort of holding back a little bit, just sort of keeping the powder dry because they're not sure what people are going to be doing. What do you think is behind this, first, on this little downturn in graduate hiring or entry-level hiring, obviously including apprentices?
We're all reading the same press articles that are talking about...
For one, do you think that factually chimes with the LMA membership, which is obviously a big number?
So look, I would think that we are facing the same challenges that any businesses in the UK is facing at the moment. I mean, there are some economic headwinds that I think leaders, doesn't matter what sector you're in, you're worrying about economic headwinds and the health of the economy. You then worrying about what is AI going to do to jobs at the more junior level. I would say at the moment the sort of dip in hiring at the graduate and entry level roles is more driven by economic concerns than it is about AI. I think a lot of it is being driven by people just being very conscious of their costs as we go into a potentially more challenging economic period. But AI is also on people's minds. They're trying to think, what does the reconfigured workplace now look like if AI were to reach its full potential? I think the challenge for the market is, and there was an LMG report on this that was issued as part of London Matters, is we actually, as a marketplace, as the London market, need to significantly increase our hiring, particularly at the junior end of the market, over the next decade. Because over that decade, we would be looking at a market, if we don't do anything, we'll be looking at a market where about 7% of employees will be aged under 30. And so that's just not sustainable as a market. So I think there's a lot for us to do as a market. I think we're doing a lot, but there is more to do. And I think market firms need to be encouraged on talent. We're going to have to play a longer game. We're going to have to deal with the sort of more immediate headwind, but we're going to have to play a longer game.
It's almost, I've got to carry on hiring. I still don't know quite what I'm going to need them for, but I know I'm really going to need them, but I'll work it out. But I probably should keep hiring at the same rate.
And the skills are going to be slightly different from the traditional skills of the past. If you look at what the LMG has been doing, so, Caroline's done sterling work in this space. And one of the best examples of that, and it was all over LinkedIn and the pictures were fantastic to see, the LMG's Lime Street Festival last summer, where we had 400 school leavers who were invited to gather outside Lloyd's, basically to help them understand why the London market is an exciting career destination. And we were represented there. 150 other firms were represented. It was like a big graduate school fair. And those are the sorts of things that give me hope that we are getting better at getting our message out, that specialty insurance is a very exciting place to work. We all fell into insurance, and once we fell into it, we loved it. And now it's a case of being a little bit more deliberate about getting the message out to the next generation that this is a great marketplace to work in and why. And again, I give credit, and obviously the LMA is hugely supportive of the work the LMG has been doing in this space, which is translating the message into language and content, social media content, etc., that will resonate with a different generation of people. And we've got to be smarter about it.
I got asked, so I probably didn't have much choice. I did a podcast with 3 teenagers. It was a really interesting event. 3 teenagers from Leicester who knew nothing about the London insurance market, and, asking them about what they thought about insurance as a potential career. And, it was quite eye-opening, actually. We had a lot of work to do. But by the end of that day, it was a fantastic day. It was part of their big day out in London, in Lloyd's. By the end of it, their eyes were opened. It was really interesting just to sort of just see what someone's vox pop initial reaction was pretty poor and negative, often very negative, actually, as well.
Well, and most people's experience of insurance isn't that exciting.
Or having a car insurance claiming.
Yeah, you do it because you have to. But, we're talking about something utterly different. And as you know, you can come in and start in one role and you can move around firms, you can move roles, and you can have a very rich career. And the truth is, once most people come into the market in London, they never leave. Stay. They move around, and it's why I love it. I mean, it's got that incredible sense of dynamism and also community.
With these things, I suppose, looking at that expense ratio, I suppose that's what people in your position have got to do. Because, of course, reading those other stories is not so much entry-level hiring right now, but everyone's frenetically hiring each other's talent that once you've got 5 years or whatever, once you reach a critical mass of experience of those tradable skills, suddenly you're very tradable. And a big percentage of that expense ratio is going on hiring those people who've got 5 years talent, and you're practically doubling their money to move them over from one of your competitors. Whereas you think maybe we'd better, if we had a bigger talent pool, that would be more helpful.
Yeah, and we've all experienced that level of wage inflation, and that's not sustainable either.
No, it can't be, can it? Because it puts you under so much pressure immediately to think, hang on a minute, if I am worth double, I've got to write twice as much for a start, or produce
well, that would be
the
wrong incentive, particularly where we are in the market. But so I think we've got to be more deliberate. I think there's a lot we can do as a market together to attract talent. But ultimately, we can attract the talent, but we need firms in the market to have the appetite to recruit that talent. And I think the work the LMA's done, the work the LMG's done, I think what individual firms are doing on their own, we've been experimenting with lots of different ways as AXA XL to reach out to school leaver talent. I think there's a lot of creativity going on, but ultimately it needs to be backed up with roles that we can hire people into.
You were mentioning about the economics. Obviously, how are our economics stacking up at the moment in terms of at this time of market? Often you can start to feel submission flows ebbing a little bit. How is it at the moment?
I would say, and I'll speak as AXA XL here rather than the LMA, because I'm not sure the LMA would take a view as to what's going on with submissions. Data, no. But from an AXA XL point of view, I would say, look, we are seeing some retrenchment of business back to domestic markets, which is not unusual as we sort of start to get to this part of the insurance cycle. We are starting to get a little bit more selective about the risks that we're underwriting. But having said that, we are still seeing a healthy flow of business into London. I'm not going to generalise as to whether it's rising, falling, but we're still seeing a healthy submission flow. It will differ by line of business, etc. But I think the market is seen to be a very attractive place for business to come to, regardless of just price. So I think there's a certain level of maturity that's happened in the market that is making business a little bit more sticky, because they see the market as offering something a lot of domestic markets can't offer.
And I just did a podcast about data centres, and of course you're suddenly talking about 10 billion limits and things that were unheard of. And suddenly, if we're a peak market, we're a capacity market, but also with that expertise, because these are things with pollution exposure, lots of quite complicated exposure built into them. And so it sounds like a risk that's sort of tailor-made for us. So there is hope. There's plenty of demand for the sort of things that we're selling.
And I think everyone's getting very excited about data centres, and it's
probably
absolutely...
shouldn't get overexcited, because the trouble with technology, of course, is that what is the size of 5 football pitches today could be the size of something that fits in your pocket by tomorrow.
Yeah, and the reality is that at the moment, if you look at the numbers that are being put out there in terms of demand, I don't think the global insurance market is able to currently meet that level of demand.
No, quite right.
So will all that demand come through? Probably not, but...
If you can't build something that big, if we've told them you can't build it that big, and between the banks and the insurance companies we can't finance something that big, then they'll just have to build them slightly smaller, won't they? I mean,
to be honest, that's where I think the insurance market can be very helpful, because whether you're a broker or an underwriter, as XL, we got 400 risk engineers all over the world. There is advice and insight that can be brought to clients early in the process.
Don't build it there. Don't build it that big.
And don't build a multi-story data centre, because you won't be able to get it insured because the PML will be too big. So there's some basic things that I think the market needs to help create the parameters around what makes sense for scaling data centres. There's a lot of activity in London, but globally too, on data centres. It is a source of new growth for the whole market. And I think, as you were saying, it should play to Lloyd's strength that this is an area that is somewhat new, needs capacity. It should be in the sweet spot of the market to get this right, and it will require the market to come together to help solve this.
Yeah. No, and obviously we're already seeing consortia and all sorts of other things being put together, and obviously the big brokers particularly making headlines with the sort of numbers they can put out. They can corral the market together on something. But it sounds really positive. Also, what's been really interesting is what's happened since we last spoke, was probably about 3 years ago. So many new different ways of getting capital into the market. I mean, there have always been so many different ways of doing it, but there seem to be even more now. So it's almost that there is a channel for almost any type of capital to find its way into Lloyd's.
Yeah.
Do you welcome that? Or do you think in the past when we've ever had lots of new capital flowing, then usually with hindsight we would have wanted to sound a note of caution before we accepted all that capital?
So I give Lloyd's executive a huge amount of credit for taking a more imaginative view as to what the capital advantages of being at Lloyd's could be. I think we've always had a fairly traditional view of what capital advantages of Lloyd's are, leveraging the central fund, double use of assets with letters of credit, etc. But I think the work that's been done over the last few years with London Bridge 2, for example, is it's opened up a channel, as you said, to capital that frankly wasn't quite there before. I think that's a good thing for the market. I think it plays to the strength of Lloyd's. It's now an added benefit and added flexibility, which makes the market appealing to a new investor group. Now, like with anything new, everybody needs to go into it with their eyes open. That's the capital that's coming in. They need to take the time to do the due diligence and understand what they're doing. But also Lloyd's and the structures that have been announced and are active. These are very sophisticated investors partnering with very sophisticated businesses in a robust and clear regulatory world that is the Lloyd's market. So I think obviously always you need to make sure the regulatory regime is fit for purpose for the players involved. But I think when you're dealing with the sophisticated institutions we're dealing with and coupled with the regulatory regime that Lloyd's and the PRA and FCA creates, I think that gives me space to be optimistic about that this is a really interesting innovation that is going to be sustainable over the longer term.
Well, it sounds really good in that, yes, we can decrease the cost of capital ultimately for all of us, make the market more efficient for everybody. As is, the more capital you can get in, the more forms of capital you can get in, the better ultimately. Of course, you're all sharing the same central fund, so you've got to be careful who you let in, of course.
Of course, and that's where we rely on Lloyd's to be able to manage that effectively, and I have every confidence that they do. And ultimately, whilst we're all competing with each other every day, we all have a shared interest in making sure that the market's sustainable. And so making sure the market is attractive to capital in that way, it's an area where it could argue Bermuda has had a little bit of advantage over other locations. And now I think Lloyd's is able to prove that you can do these kind of structures in London and you can do them in a capital sufficient way. So I think that's good for London, it's good for Lloyd's, and it's good for the future of the market.
Yeah, exactly. You had mentioned the enhanced underwriting report, which I'd say that would be your predecessor would take the congratulations for that, and Sheila, absolutely, because it's probably the most cited report. It's the definitive work on that topic, which has been really, really good. And since then, of course, the whole world of smart follow, portfolio underwriting, broker facilitation. I mean, all the top 10 brokers have got a facility, or if they haven't, we're working on one frantically right now, and the top 20 brokers are probably all doing it. How far do you feel this phenomenon has to run? And also from the underwriting side, almost everybody has got a portfolio underwriting unit or is about to set one up or is really seriously looking at it. Again, part of market efficiency, we're deepening and improving that capital base and diversifying that capital base, and we're also making underwriting more efficient and placing business more efficient.
So I don't see it as a phenomenon. It's a structural change, and it's one that's been happening over a period of time and is accelerating for sure. So yeah, I give Sheila and the team a lot of credit for stepping into the space and getting the debate going, as we touched on earlier. So look, broker facilities have been around for a while. I think they're here to stay. Some people may say they're cyclical. I personally believe that these are a way of driving efficiency into an inefficient capital deployment structure.
Yeah, when I talk to brokers, they're very conscious that this is a fundamental pillar of the way that we do business now, because this means we can improve our productivity, which is massively important. We can't double the size of the market. If we have to keep doubling the size of the employee base, it's not going to work economically that way. And so they're very conscious when they talk about their facilities. There's not just something that they use that they're going to dump into and burn, and at the bottom of the soft market, they're all going to be pulled, because that would not work for them. We'll see as the market softens, and if the market softens a lot, we'll see what actually happens. But they understand that it's absolutely in their interest that these be sustainable, because otherwise they won't be there when they really need them.
And I think they are doing a lot of work to make sure that that's the case. And I think that's absolutely the right analysis. I think they recognise this is a very good mechanism for them, for their clients, and actually for the market, but it only works if it's sustainable for everybody. So I think those broker facilities are here to stay. They may, in scale terms, ebb and flow from a cyclical point of view, but structurally, I think they're here to stay. The digitisation of the deployment of follow capacity, I think also is here to stay. And we've seen some great innovation in the market, which goes back to what I was saying about this market being incredibly dynamic. And I think, again, what that is doing is testing the boundaries of how does capacity get deployed using technology and using AI. And it's proving that it can work, and it can start to work at scale. So that's now got everybody's attention, and everybody, as you say, is now looking at portfolio solutions, whether it's broker facilities or whether it's looking at we call it here at XL, we call it active follow. So it's you're making active underwriting decisions. You're just doing it in a very, very efficient way, and you're able to deploy capacity quickly when a broker's looking to fill the slip. And then what the LMA issued obviously last week was the role of the leader, which is at the end of the day, the facilities and the active follow only work if you've got good leaders in the market. And for the long-term sustainability of the market, we need strong leadership. And that report, and if you haven't read it, I would encourage you to go to the LMA website and download it and read it, because it's a very interesting report. So when we say what makes a good leader, let's get past the sort of perception and try and drill into being a little bit more analytical about what it is that defines being a good lead underwriter in this marketplace. And the idea is to get that debate going. And it's created a tool for underwriting businesses in the market to go by line of business and say, are we really a leader in this market?
I mean, of course,
or
we
are
know
we
that
pretending?
There's a perception gap, isn't there? And everyone says, no, we lead everything. It's like, you don't, do you? You can't possibly lead everything. For one, that's not physically possible. You can't all be above average either. You know, it's just a mathematical certainty that some of you have to be below average to make it average out.
Yeah.
So, funny enough, this is episode number 1 of the podcast in 2019 with Sheila Cameron. This is what we were talking about. Would you say that you've got to leave the market to decide these things? Let the broker and the clients decide who the leaders are. For a start, I remember discussing this 6 years ago, we wouldn't have a situation where you have to kind of have a leader's badge and it could be taken away. So you can't lead because you're not designated as being a leader and you're qualified as a leader. Do you think the market will decide perfectly efficiently without being told?
There was talk, a while ago that Lloyd's would accredit leaders. I don't think anybody's got really any interest in that. I think this goes to the commercial heartland of the way the market operates. But we've got to get past this sort of, you'll know it when you see it as to whether or not someone's a leader or not. But what the report is trying to do is equip people to decide how they want to pitch up to clients and brokers in that line of business, because you can be a really true leader where you're influencing price. You can be a capacity leader where you're actually more of a price taker, but you're putting a big line down, and so on and so forth from there. So there's lots of different features that define leadership. I think it's down to a combination of clients, brokers, but also followers. Because at the end of the day, the broker needs to find a leader that the market is going to follow. And so it's a combination of the very best of how the market operates. In combination, brokers have a view, clients have a view, but also followers have a view. And this is just the way the market works. So I don't think any one voice is stronger than the other. It's just the yin and the yang of the way the market works.
The claim service particularly as well.
Claim service is critical and often overlooked, because it's all about, the underwriter. But actually, a lot of what the broker and client are looking for is ultimately about the claim service. And so people are looking for slightly different things from the leader. And all of those are sort of put in a big pot, mixed around. And then, sort of leaders pop out the other end.
So do you think we'll have some form of accreditation then? Yes or no? I mean, the market seems pretty efficient at deciding for itself.
Yeah, I don't think we're going to go down the route of accreditation. That's certainly not something I think the LMA would support, and I don't think Lloyd's would have any particular interest in trying to take on that role.
Because it would be impossible. Because also then, what if that key underwriter leaves and moves to a competitor? Then who's the lead now?
And the commercial implications for businesses would potentially be quite significant. And so I think it is better left to market forces. There's no one right answer on what the right business model is, and businesses will decide for
What about
themselves.
things like, fees, for example, leaders' fees. Again, do you think that you should leave that for the market to decide? Sometimes in the past, Lloyds might have regulated these, not to say negative, but they'll tell you what you can't do. You can't write ton of policies. You can't do this. You can't gross up.
Yeah.
Do you think it might be more of one of these sort of the absence of the negative rather than an absolute positive, endorsing a particular way of doing things or not a particular way of doing things, but at least saying, as long as we don't say you can't do it, you can do it.
I don't think, again, Lloyds has any interest in stepping into the space, and there is no consensus in the market in any event. And again, it's very much a commercial issue as to...
So if you can make it fly and it works... And
we
market's
see,
happy, then that's fine,
and we see
right?
leaders' fees in consortia. So the market has found a way of getting their heads around that when you're leading a consortia, there is some fees that go with running the consortium. On core open market business, there isn't any consensus, and this debate's been around for years. So it's not as if the market hasn't looked at it.
Because if you write the lion's share, you're getting the lion's share of the income.
And there are advantages.
And it's in your interest to have a good claims department because you're paying 40% of it anyway. So,
and, let's be honest, people fight for the leadership for a reason, because they want to be able to decide how much of the risk they take. They want the relationship with the client. They want to manage the claim themselves. So that competitive dynamic keeps people honest about what they need to do and what they need to be a leader. So the market, as I said, has no sort of single view on it. There are mixed views. You then go into certain segments of the market, like the aviation market, which has vertical pricing in it. So, there's lots of nuances here. A one-size-fits-all isn't the right way to go.
Yeah. Do you think with the technology, everything's placed electronically, when it's even more explicitly electronic trading, do you think vertical pricing is more likely to come in most classes? That's my sort of working assumption.
It's a possibility. I think that would be generalising quite a lot. I think one of the benefits we get from the way in which the subscription market works is the efficiency for the broker and the client. If it wasn't delivering value for clients, we would be in a different place in terms of how the market operates and how the pricing is structured. So I think as long as we're focused on the client outcome we're trying to deliver and the brokers see value in the way the market is structured and the way the market works, it may evolve, but it does work for clients.
Going back to the portfolio solutions, underwriting, fast follow, smart follow, what sort of percentage do you think of the market, of the average order, would be placed automatically in about 5 years' time?
That's very difficult to say. What we're seeing is a lot of growth. So again, if you go back to the enhanced underwriting report that you mentioned that was issued in 2024, that already assumed or sort of estimated that there was about $5 billion of premium that was already transacted in that way. And that report projected out 10 years and said that it could be 40 billion. Now, obviously, what proportion of the market that might be, I don't know. But I think it has the real potential to scale. But there's a lot that needs to be done in order to facilitate that scaling. And we're not there yet. And different businesses in the market are moving at different paces, and different brokers are moving at different paces. So this is an area where I think people will continue to explore opportunities, but at some point I think there is a chance that the switch can flick and we would see a significant movement. But at the end of the day, it comes down to some of the things that, Sheila and others have been doing on the Data Council, because you've got to do it based on a common set of data that everybody understands and everybody buys into. And we're sort of making progress there, but it's got a little bit of a way to go.
Where does Blueprint 2 fit in with this? And I'm calling it Blueprint 2 for the moment because in the absence of a new name, obviously I've been reading reports about whether this has been discontinued or not. Obviously, it seems this is something that has been problematic and is going to iterate, to say the least. How important do you think that is? And obviously, we know it's fundamentally important to get it right. Is it the absence of it holding anyone back?
No, is the short answer. And I'll come back to Blueprint 2 in a moment. Whilst that project has been ongoing, the market has been moving on regardless. And that's a positive thing. So, again, put my XL hat back on. We've been doing some pretty significant work with Marsh and with McGill. It's all in the public domain on how we can trade digitally outside of any centralized system or any centralized bureau. And there is clearly a way of doing it. We're already benefiting from that now, and there is that opportunity to scale. So I think the good thing is nobody's been sitting on their hands waiting for Lloyds to solve the problem for them.
Yeah. What about that fundamental architecture problem? Because we could have had this conversation 20 years ago after the Connect system was abandoned. There was a movement it was called the G6, wasn't it?
Yeah.
In fact, Sue
Sue
Langley was
Langley.
part of it.
Yes, she was.
She mentioned it in her
Small
podcast,
world.
actually. G6 was, let's go peer-to-peer. We can be decentralized. Technology is allowing us to decentralize, particularly if we have these common Lego bricks of data that are all the same. We can shuffle them around. It's far easier to count them and to move them around. I'm not techie enough to know the fundamental architecture that we need in 2026 and, looking forward up to 2050. Something that we're building. Some techie people say to me, well, we don't need a bureau anymore because, you've got these bricks so you can just fire them around at each other and they're fine because you can all ingest them really easily and they're all interoperable. I don't know. What do you think? Are you not techie enough either? This is usually the problem, I think, with the insurance industry, isn't it?
Yeah, I can take the conversation to a certain point, but then I get quickly out of my depth. So look, I think, as I said, we have got a common data framework. So the Accord standards are a great place to start. And obviously, that's what the Data Council has been building on. And that's certainly what we're using in the work that we're doing with the brokers that we trade with. And getting that common data architecture sorted out, I think the big difference is now we have the API connectivity with our brokers and with the core trading systems that operate in the market. So we are API connected directly peer-to-peer with a number of brokers, and we are also API connected to Whitespace and to PPL. That allows us to exchange data via that API rather than people sending emails to each other. So that in of itself is a huge advance.
Still need, I suppose you need the net settlement. The big thing says, by the way, we've got a market where everybody owes each other a little bit of money, but you can just net it off at the end of the day and say, by the way, just pay me £5 and then we're all quits.
Yes, so that is a core element that needs to be solved for, but there is a lot that can be already done peer-to-peer and is being done peer-to-peer outside of the bureau, and that can scale. There is no question about that. Going back to
how it evolves, really.
So look, we're very keen to see how it evolves because we think it's a hugely efficient way of deploying capacity. Just going back to Blueprint 2, so I guess from an LMA point of view, we've got to break it down into its core elements in terms of what's actually really important to the LMA. So first and foremost, we have to make sure that the legacy systems are sustainable and they are resilient. We have to make sure that come what may, whatever change will or won't happen over whatever time frame, that we can continue to pay claims and collect premium, the basics. So making sure that the underlying infrastructure that supports the market is resilient, that is critical. With that in mind, we also have to have an eye to the fact that we need to re-platform some of that in old architecture and old mainframe technology, and therefore some re-platform, which was the most recent focus of Blueprint 2. We have to continue with that. So the second priority is, look, we've got to make sure the core technology is resilient. Secondly, we've got to successfully re-platform this so we have a more modern estate supporting the market, and that we can move to that platform in a way that's safe. And obviously the LMA is working very closely with Lloyd's, the IUA and LIBA, because that's a shared objective across the market. Until we get to that modern infrastructure, we can't deliver some of the things that might be delivered centrally, might be better delivered centrally than firms doing it peer-to-peer. What I would say is that needs to be now reassessed, because obviously Blueprint 2 has been running for a very long time, and the market's moved on in the way that I described. So It does call into question you raised about what is the role of a centralized bureau? Yeah. What does the market need? Because what you're seeing is firms evolving and doing more peer-to-peer, which is, I think, a great strength. You've got the structure of the market changing in the way that we've discussed. So the growth of facilities, the growth of algo trading, that is changing a lot of the features. So we've got to be careful that we're not building a centralized infrastructure for the market as we understood it 10 years ago, rather than the market as it's going to be in 5 years.
Yeah.
And so I think there's an opportunity for Lloyd's to take a bit of time to reassess what is actually required, given everything that's been changing in the market in the meantime.
But there's that core refresh that has to happen, because
we have to carry on functioning.
If the system switched off, it would be a nightmare, wouldn't it, for everybody? No one would know where they were. Claims not being paid. And you wouldn't be having lunch at number 11 Downing Street. They might summon you in to sort of for a ritual beating.
And it's commercially important for the market, because we have to be able to pay claims and collect our premium, service our clients. And that's important, but it's also important for the PRA and the FCA, are very focused on operational resilience, rightly so, across financial services. So it's a core question that we all need to have good answers to, which is why it's the number one priority for the LMA when it comes to that agenda.
I remember the ECF, of course, again, probably around that G6 time, that was when Richard Ward came in. One of his first big stands he took was sort of, I'm going to get rid of those vans that drive down to Chatham with all those bits of paper. I don't know what we're doing. It's the 21st century. We don't need that anymore. And he was right, and people grumbled. And then the ECF was born, and there are many subsequent iterations of that. And probably because of that, the legacy is that claims are in pretty good shape, actually. So a lot of the claim systems are a lot newer than the underwriting systems. So taking that lesson, that was a mandated change. With the data, when you've got a core data record that everyone's happy with, do you think there should come a point where it should be mandated? This is like the minimum price of entry to the London market.
Potentially, but I think you have to get to if I go back and put my old Lloyd's hat on, to mandate anything, you're mandating to bring along the stragglers rather than mandating to try to get everybody to do something all at the same time. And I suppose
it better be right, hadn't it?
Yes. And so, look, I think the work that's been done on the core data record, which is a subset of the Accord standard, so it's built on a robust sort of template that's industry recognised, is a very good first step. And it is already enabling us to do the digital stuff that I've talked about. So it's already delivering benefits. But what you're talking about, particularly with peer-to-peer, is these are investments that firms have to decide what they want to prioritise. And is this at the area where they want to invest? And that's an individual commercial decision that's being taken. So I think there is a place for agreeing common standards, but I think we're a little bit away from mandating how the market should trade electronically, because I think we're in a phase where people are figuring it out for themselves. And that's good for the market because it's going to help us get ultimately to the right answer. At the end of the day, for us, we're doing some really interesting things, as I say, with some brokers on digital trading. But the benefit only comes ultimately when everybody moves in the same direction. We can do it ourselves and we might get a bit of first mover advantage for it. But the reality is the benefit will come in time when this is just the way the market trades. And for that to happen, we need more of this, we need more consensus, and we need to start seeing more activity in the market.
I suppose, any comparative advantage in insurance is always short-lived because people can see what you've done.
We're a very transparent market, so if somebody's gaining an advantage because they've done something, generally speaking, it doesn't last that long.
No, quite right. And then it becomes an advantage for everybody
exactly
comparatively against another market where that insurance could be placed. I'm looking at my questions. I think the only thing I haven't asked you about is, in parallel to all these other big changes we've had since we last spoke, we've had a continuation of, let's say, an increased share in the insurance value chain going through MGAs or through delegated underwriting. Do you think this is something that's another permanent change in the way that things are being done? Obviously, some of those broker facilities, of course, actually the actual structure they're using is an MGA, for example, even so. But of course, we've had all that growth we've had the birth of the hybrid MGA carrier, for example. And again, a lot of it seems to be technologically based in that we can ingest those portfolios, we can really understand them, we can back the right underwriters, we can then get sophisticated capital to come in behind us, go straight to the reinsurers or alternative capital. It does seem to be that a sort of better mousetrap has been built. Well, that would be what they all say. And obviously I have a lot of those people that have been on the podcast because they've built some phenomenal businesses that have come from sort of naught to many billions in premium in quite a short period of time. So they're remarkable to talk to, great entrepreneurs. Well, what's your view on this? Do you think this is totally sustainable? And do you think this is a permanent secular change in the way things are going?
I mean, delegated has always been a significant part of the London market portfolio and Lloyd's in particular, so I don't see that changing. Will it continue to grow at the same pace? I think to some degree that's going to be driven by the cycle. I think there is massive advantage to delegated underwriting done properly. And as you say, some of those businesses have proven very adept at harnessing technology and producing very good data analytics, which gives you confidence to back them when you're looking at deploying capital. Not all delegated arrangements are the same, but I would say we see continued innovation in how those MGAs are becoming more and more sophisticated in how they do what they do.
Yes, someone would say to me, well, my paper provider loves me because I've got better systems than they have, because obviously I only started 3 years ago. I had no legacy.
No legacy. Often they're in specialized lines. They're very highly focused on the client broker segment they're transacting with. They're able to deploy technology much more nimbly. So all of those things are very good things that as a capital provider, you look at very closely and say, well, I couldn't actually do that myself. So it's a great way of deploying products which otherwise would be talking about specialty products, for example, that would be hard to scale into those client segments. It's a great way of getting them scaled in an efficient way. So I think there's room to see some continued growth. It may not come from typical channels like the US, for example, because we might see some retrenchment back to the domestic market, which will be cyclically driven. But, if you look at Europe, the maturity of the delegated model in Europe is not as mature as it is in the US and in the UK. So we're starting to see growth in Europe. So I think it's hard to sort of say overall, is it going to continue to grow at the same pace? I suspect the cycle will decide that it isn't. But there is opportunities for growth. It may just be coming from different areas and new areas where delegated isn't mature, but we're seeing MGAs seeing opportunities and they'll need capital to back them.
Yeah, actually, I had William Pitt of FAYS, which is, if you know the MGAA in the UK, then this is the pan-European sort of MGAA trade body for MGAs. And I've listened to him, and obviously, the potential in Europe is enormous. And I'm sure somebody equivalent would say the same in Asia Pacific.
And the London market and Lloyd's market in particular, is very skilled at how to underwrite delegated business. We can bring actually a lot to support that growth in Europe and ultimately benefit from that deployment of capacity.
And obviously, not to forget South America or Central America or Africa either, because I actually also had Gabriel Holschneider of AXA Global, who they write 200 million out of South America, and the largest MGA in South America, but a really big business and globalizing as well. So, Sean, thank you so much for your time. I think I've come to the end of all my questions. Conscious of you've probably got to run off to a meeting. You usually do. Well, you must be. You've got so many different roles.
Well, look, it's been great to catch up, great to chat. A lot going on in the market. Always plenty to talk about. So
I've really enjoyed talking. Yes, you don't change, which is what's so good. When I first met you 20 years ago, you haven't changed much.
Slightly less hair and a few more wrinkles.
Absolutely. But anyway, I hope it's not too long before we have another chat.
Be great.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.